If you are a senior citizen in America, or if you have a parent, grandparent, or loved one who is over the age of 65, then you absolutely cannot afford to miss what we are about to share with you today. Because right now, in the halls of Congress and inside the corridors of the Internal Revenue Service, something significant is happening that could put up to $6,000 back into the pockets of millions of older Americans. This is not a rumor. This is not clickbait. This is a real, verified legislative development that is already being discussed by tax experts, senior advocacy groups, and financial planners across the country. And if you are not already aware of this new senior tax deduction, then the next 30 minutes could be one of the most financially important 30 minutes of your entire year. So please, do not go anywhere. Sit tight, take notes if you need to, and let us walk you through everything you need to know. Hello, everyone, and welcome back to U.S. Benefits Today. I am your host, Claire Hollister, and if this is your first time joining us, welcome to the channel where we break down the latest news on government benefits, tax relief programs, financial assistance, and policy changes that directly affect everyday Americans. We do the research so you do not have to, and we present it in plain language that everyone can understand. If you have been with us for a while, you already know that we take this responsibility seriously because the information we share can genuinely change lives. Today is no exception. So let us get right into it. We are talking today about a brand new senior tax deduction that has been making waves in Washington and in the personal finance community. Specifically, we are talking about a potential $6,000 above-the-line tax deduction that would be available exclusively to Americans aged 65 and older. This proposal, which has gained serious traction in Congress and is tied to the broader budget reconciliation conversations happening right now, would allow qualifying seniors to deduct up to $6,000 directly from their taxable income. And before you tune out thinking this is just another Washington promise that goes nowhere, let me tell you something important. This is not a brand new idea dreamed up overnight. This deduction has real legislative support, real momentum, and real implications for the millions of seniors who are struggling with rising costs, fixed incomes, and an outdated tax system that has not kept pace with the financial realities of aging in America today. So what exactly is this deduction and where did it come from? To truly understand what is being proposed right now, we need to go back and look at the broader picture of how seniors are taxed in the United States. For decades, financial advocates and senior rights organizations have argued that the American tax code is fundamentally unfair to older citizens. Here is why. When you retire, your income typically drops dramatically. You are living on a combination of Social Security benefits, retirement savings withdrawals, perhaps a small pension, and if you are lucky, some investment income. Now, the problem is that the existing standard deduction, while it does offer a slightly larger amount for people aged 65 and older compared to younger taxpayers, has not come close to keeping up with the real-world costs that seniors face every single day. We are talking about skyrocketing prescription drug costs. We are talking about Medicare premiums that continue to climb year after year. We are talking about home health care, assisted living, property taxes, utilities, and just the basic cost of living that has been pushed higher and higher by inflation. Seniors on fixed incomes have been squeezed from every direction, and the tax code, despite being reformed several times over the past 2 decades, has largely left them behind. The calls for a dedicated senior tax relief measure intensified during and after the COVID-19 pandemic, when it became painfully clear that older Americans are among the most economically vulnerable population groups in the country. Many seniors saw their retirement savings eroded by market volatility. Many were unable to return to part-time work due to health concerns, and many found themselves caught between rising living expenses and a Social Security cost of living adjustment that, while appreciated, simply did not go far enough to cover the gap. Advocacy groups like AARP, the National Council on Aging, and dozens of state-level senior organizations began lobbying aggressively for a targeted, meaningful tax benefit that would acknowledge the unique financial challenges of retirement. And slowly but surely, those calls began to get traction in Washington. Fast forward to the current legislative session, and we are now seeing concrete proposals on the table that would translate those years of advocacy into real, tangible relief. The $6,000 senior tax deduction is the most prominent and most discussed of those proposals, and it is the one we are going to focus on throughout this video. Now let us talk about who qualifies for this deduction, because this is the part that most people want to know first. Based on the legislative proposals that are currently being discussed, the primary eligibility requirement is age. To qualify for the full $6,000 deduction, an individual must be at least 65 years of age by the end of the applicable tax year. That means if you turn 65 before December 31st of the year in which this deduction goes into effect, you would be eligible to claim it. Now, the deduction is structured as an above-the-line deduction, which is a very important distinction and one we will explain in detail in just a moment. But first, let us continue walking through the eligibility criteria. In addition to the age requirement, the proposals that have been circulating include income thresholds that are designed to target the benefit toward middle-income and lower-income seniors who need it most. Based on current legislative language being discussed, individual seniors with a modified adjusted gross income of up to $75,000 per year would be eligible for the full $6,000 deduction. For married couples filing jointly, the threshold being discussed is up to $150,000 in combined modified adjusted gross income. For seniors whose income exceeds these thresholds, the deduction would begin to phase out gradually, meaning it does not disappear all at once, but rather reduces incrementally as income rises above the limit. This phase-out structure is designed to ensure that the benefit flows primarily to seniors who are genuinely struggling financially, rather than to high-income retirees who may have substantial investment portfolios and other resources available to them. It is also worth noting that this deduction, as currently proposed, would be available regardless of whether you itemize your deductions or take the standard deduction. This is the critical above-the-line distinction I mentioned a moment ago, and it is enormously significant. Let me explain why. There are two ways to reduce your taxable income when you file your federal tax return. The first is to take the standard deduction, which is a flat dollar amount set by the IRS each year that you can subtract from your income without having to document individual expenses. The second is to itemize, which means you list out specific deductible expenses like mortgage interest, state and local taxes, charitable contributions, and medical expenses, and you deduct the actual total of those items instead of taking the flat standard deduction. Most seniors actually take the standard deduction because their itemizable expenses do not exceed the standard deduction threshold. An above-the-line deduction, by contrast, is one that you can claim before you even get to the point of choosing between the standard deduction and itemizing. You subtract it from your gross income to arrive at your adjusted gross income, and then you still get to take whichever deduction method is most beneficial to you on top of that. In practical terms, this means that virtually every qualifying senior would be able to benefit from this $6,000 deduction, regardless of their specific financial situation or tax filing strategy. Now, let us talk about the actual dollar impact, because this is where things get really interesting and where the real-world significance of this proposal becomes clear. A $6,000 above-the-line deduction does not mean you get $6,000 as a check or a direct payment. Instead, it means you reduce your taxable income by $6,000, and the tax savings you realize depend on your individual tax bracket. For a senior who falls in the 12% federal income tax bracket, a $6,000 deduction would translate into approximately $720 in actual tax savings. For a senior in the 22% bracket, that same deduction would be worth about $1,320 in reduced tax liability. And for those in the 24% bracket, the savings would reach approximately $1,440. Now, you might be thinking that those numbers sound modest compared to $6,000. And technically, you are right that the deduction itself is not the same as a $6,000 check. However, there is another layer to this that makes the benefit even more valuable for many seniors. Because the deduction reduces your adjusted gross income, it can also have ripple effects throughout your tax return. A lower adjusted gross income can reduce the amount of your Social Security benefits that are subject to federal income tax. It can affect your eligibility for certain other credits and deductions, and it can reduce your Medicare income-related monthly adjustment amount, which is the extra premium that higher income beneficiaries pay for Medicare Part B and Part D. So while the headline number is $6,000 in deductible income, the true financial benefit for many seniors could actually exceed the face value of the deduction itself when you account for all of these interconnected effects. Let us now turn to the timeline, because one of the most common questions we receive from our viewers is always the same thing. When will this actually happen, and when can I expect to see a benefit? And I want to be straightforward with you here, because that is what we always try to do on this channel. The $6,000 senior tax deduction is, as of the time we are recording this video, still in the legislative process. It has not yet been signed into law. However, the momentum behind it is real and significant. And here is what the current timeline looks like based on available information. The proposal has been included in broader tax and budget legislation that congressional leaders have indicated they intend to move through the reconciliation process. The reconciliation process, for those who may not be familiar, is a specific legislative procedure that allows certain budget-related bills to pass through the Senate with a simple majority of 51 votes rather than the 60 votes normally required to overcome a filibuster. This is significant because it means that if the political will exists on one side of the aisle, this deduction could potentially become law without requiring bipartisan support, though bipartisan support would certainly make the path smoother and more certain. Congressional leaders have discussed a timeline that would aim to have relevant legislation passed and signed before the end of the current fiscal year. If that happens, the deduction could take effect for the tax year in which the legislation is enacted, meaning seniors could potentially claim the benefit when they file their taxes in the following calendar year. Some versions of the proposal have also discussed making the deduction retroactive, which would allow seniors to claim it for a prior tax year through an amended return. However, retroactive provisions are often the first things to be negotiated away in the legislative process, so we would not count on that aspect until it is confirmed in final legislation. What we can say with confidence is that this proposal is being taken seriously. It has real advocates in Congress, and if history is any guide, the political popularity of senior-focused tax relief makes it a strong candidate for eventual passage. Seniors vote at very high rates, and elected officials on both sides of the aisle have strong incentives to support measures that benefit this demographic. What are the experts saying about all of this? Because it is not enough to just know that a proposal exists. We want to understand what people who study tax policy and retirement finance for a living actually think about the merit and the likelihood of this becoming law. The reaction from the financial and tax policy community has been broadly positive, with some important nuances worth noting. Tax policy analysts at several nonpartisan research organizations have pointed out that the structure of an above-the-line deduction is well-suited to delivering broad-based relief to middle-income seniors, precisely because it benefits people who take the standard deduction just as much as those who itemize. This is seen as a more equitable approach than some previous proposals that would have primarily benefited wealthier retirees with large portfolios of deductible expenses. Senior advocacy organizations, including some of the largest and most respected in the country, have praised the proposal as a meaningful step toward recognizing the financial realities of retirement. They have pointed out that the existing additional standard deduction for seniors, which adds about $1,500 to the base standard deduction for individuals 65 and older, has not come close to keeping pace with the actual costs of aging. A $6,000 deduction would represent a substantial and long overdue upgrade to that benefit. Some fiscal conservatives have raised questions about the revenue impact of the deduction, noting that reducing taxable income for tens of millions of seniors would reduce federal tax revenue by a significant amount over the 10-year budget window that Congress typically uses for scoring legislation. Estimates of the revenue cost vary depending on the specific parameters of the proposal, including the exact income thresholds and phase-out ranges. But figures in the range of several $100 billion over 10 years have been cited in some analyses. Supporters of the proposal counter that this cost must be weighed against the very real economic benefits of keeping more money in the hands of seniors who are likely to spend it locally, supporting small businesses and local economies, and reducing the need for other forms of government assistance as seniors have more resources to meet their own needs. Progressive economists have also noted that the deduction's income phase-out structure helps limit the revenue cost by ensuring that the largest benefits flow to those who need them most rather than to affluent retirees who have many other tax planning tools available to them. Financial planners and retirement advisors have been particularly enthusiastic about the potential of this deduction to change the tax planning calculus for their senior clients. Many planners note that the above-the-line structure creates opportunities to combine this deduction with other strategies, such as Roth IRA conversions, strategic charitable giving, and careful management of required minimum distributions from retirement accounts to achieve significantly better overall tax outcomes for senior clients. If this deduction passes, expect to see a wave of interest among seniors and their advisors in reviewing and potentially restructuring their financial plans to maximize the benefit. Now, let us talk about what this actually means for real people, for real families across this country, because at the end of the day, that is what matters most. According to the most recent Census Bureau data, there are approximately 56 million Americans aged 65 and older living in the United States. Of those, the vast majority live on annual incomes that would fall below or near the income thresholds being discussed for this deduction. Social Security remains the primary source of income for the majority of retired seniors, and the average Social Security retirement benefit is approximately $1,900 per month, or roughly $22,800 per year. Many seniors supplement that with some modest retirement savings distributions, perhaps a small pension, and in some cases, part-time earnings. But for a huge swath of the senior population, annual incomes in the range of $25,000 to $50,000 are very common, and that places them squarely in the eligibility zone for the full $6,000 deduction. For a retired couple living in a mid-sized city, perhaps in a state like Ohio or Tennessee or Arizona, bringing in a combined $45,000 per year from Social Security and a small retirement account, the ability to deduct $6,000 each from their federal taxable income could be genuinely life-changing. We are talking about potentially saving $2,000 or more in federal income taxes for the household, money that could go toward covering a portion of their Medicare premiums, paying for prescription medications that might otherwise be rationed or skipped, making a needed home repair, or simply providing a cushion against the kind of unexpected medical expense that can wipe out a modest retirement account with frightening speed. For seniors living alone on very limited incomes, even a few $100s in additional tax savings can mean the difference between a month where all the bills get paid and a month where impossible choices have to be made between food, medication, and utilities. It is also worth thinking about the indirect economic benefits of putting more money in the hands of senior citizens. Studies consistently show that older Americans, particularly those with modest incomes, tend to spend a very high proportion of any additional money they receive rather than saving it. They buy groceries at local stores. They pay local service providers for home maintenance and healthcare. They support local restaurants and small businesses. When you give seniors more financial resources, that money tends to circulate through local communities in ways that create jobs and support economic activity. So the $6,000 senior tax deduction is not just a benefit for the individual seniors who claim it. It has the potential to be a meaningful economic stimulus for communities across the country, particularly in areas where retirees make up a large share of the population. We also want to acknowledge something important for the many Americans who have parents or grandparents who rely on them for financial support. When seniors have more financial resources of their own, it reduces the financial burden on their adult children and grandchildren who might otherwise need to step in and help cover expenses. We know from research that a significant number of working-age Americans are currently providing some level of financial support to elderly family members, and that this support often comes at the cost of their own retirement savings, their children's education funds, and their own financial security. Anything that reduces the financial strain on seniors has a positive cascading effect throughout families and across generations. Let us now bring everything together with a final summary of what we have covered today, because we have gone through a lot of information, and we want to make sure you leave this video with the key points crystal clear in your mind. First, there is a serious and significant legislative proposal currently being discussed in Congress that would create a new $6,000 above-the-line tax deduction exclusively for Americans aged 65 and older. Second, this deduction would be available to seniors with modified adjusted gross incomes up to $75,000 for individuals and up to $150,000 for married couples filing jointly, with a gradual phase-out above those thresholds. Third, because it is an above-the-line deduction, it would benefit virtually all qualifying seniors, regardless of whether they itemize their deductions or take the standard deduction, making it one of the most broadly accessible senior tax benefits ever proposed. Fourth, the actual tax savings from this deduction would range from approximately $700 for seniors in the 12% bracket to over $1,400 for those in the 24% bracket, and the benefit could be even larger when you account for the ripple effects on Social Security taxation and Medicare premiums. Fifth, the timeline for this proposal to become law is uncertain but real, with congressional leaders discussing passage through the budget reconciliation process within the current legislative session. And sixth, the real-world impact on millions of seniors across this country could be substantial, providing meaningful financial relief to people who are living on fixed incomes and facing rising costs at every turn. If you or someone you love is 65 or older, the most important thing you can do right now is stay informed about this development. This is not the time to disengage from the news or assume that Washington will not follow through. This proposal has real momentum, real advocates, and real implications for your financial life. We will be covering every development as it happens right here on U.S. Benefits Today, so you will always have the most current and accurate information available. We will also be doing follow-up videos that dive deeper into specific aspects of this proposal, including exactly how to claim the deduction once it becomes law, how to adjust your tax withholding or estimated tax payments in anticipation of it, and how to combine it with other tax strategies to maximize your overall benefit. So there is going to be a lot more coming on this topic, and you are not going to want to miss any of it. Before we wrap up today, we want to take a moment to remind you of something we say on this channel all the time. The government does not always do a great job of making sure that people know about the benefits and relief programs that are available to them. It often falls on channels like ours and on you as viewers to spread the word and make sure that the people who need this information actually get it. So if you found today's video helpful, and we certainly hope you did, please take 30 seconds right now to share it with someone who needs to hear this. Send it to your parents. Send it to your grandparents. Post it to your social media. Text it to a friend who you know is retired or approaching retirement. A simple share could make a genuinely significant difference in someone's financial life, and that is not an exaggeration. And of course, if you have not yet subscribed to U.S. Benefits Today, now is the perfect time to do that. Just hit that subscribe button and make sure you have the notification bell turned on because we publish new videos regularly covering the latest updates on Social Security, Medicare, tax relief programs, government assistance, immigration benefits, and everything else that affects the financial lives of Americans across this country. We read every comment that comes in, and we use your questions and feedback to shape our future content. So please drop a comment below and let us know what you thought of today's video. We would especially love to hear from any seniors out there who are watching and who want to share how a benefit like this would impact your life. Your stories matter, and they help us continue to create content that actually serves the community. Thank you so much for being here today. I am Claire Hollister. This has been U.S. Benefits Today, and we will see you in the next video. Stay informed, stay engaged, and take care of yourselves and each other.